Imagine waking up today and seeing silver crash down to $62.70, only to explode back above $70 within hours. That kind of move isn't normal market behavior, it's raw emotion, panic selling, and massive FOMO slamming into each other in real time. And the biggest question everyone is asking right now is simple: what caused this? Is this the beginning of a historic breakout, or the setup for a brutal correction? Over the next few minutes, we're going to break down exactly what happened behind the scenes, the forces driving this volatility, and what it means for investors right now. Silver has been on a monster run this year, doubling in value and leaving even gold in the dust. Major financial outlets like FT and Business Insider have already called this one of the most aggressive silver rallies in modern history, driven by a combination of macro factors and industrial demand. With the US Federal Reserve cutting interest rates and signaling a softer monetary environment, precious metals instantly became more attractive. At the same time, the supply side has been tightening for years due to falling mine output, while industrial sectors from electric vehicles to AI data centers to high-efficiency solar are consuming more silver than ever before. This created a perfect background for explosive price action, but even in a strong bull market, the sudden drop to $62.70 raised eyebrows. The dip appears to have been triggered by short-term profit-taking after consecutive days of aggressive gains. When metals climb too quickly, traders who rode the move often cash out, leading to sharp but temporary sell-offs. Technical indicators also showed overbought conditions, which made the market vulnerable to even small waves of selling pressure. Add to that a bit of hesitation from momentum traders, and you had the recipe for a quick decline. The real shock, however, was the violent reversal. Silver didn't just recover, it launched back above $70 in what looked like a wave of panic buying. This kind of fast recovery usually comes from a combination of retail FOMO and algorithmic momentum trading. As soon as silver bounced off the mid-$60 range, an area that had become strong psychological support, traders started piling back in, afraid of missing the next leg up. News headlines about record highs added fuel to the fire, and social platforms lit up with people announcing they were buying regardless of the price. Momentum algorithms detected the influx of buy orders and accelerated the rally, turning a normal recovery into a rapid surge. From a technical perspective, the $65-$70 range has become a battleground. The market sees these round numbers as emotional price points. Breaking above $70 again wasn't just a price event, it was a psychological victory for bulls. Indicators remained stretched, suggesting the asset is in a high volatility phase where sharp spikes and drops are both likely. But that's exactly what attracts traders hungry for fast gains. Behind all of this is market psychology. FOMO is one of the strongest forces in financial markets, and right now it's at full power. People aren't just buying silver because it is valuable, they're rebuying it because they're terrified of missing out on what could be a historic run to $80, $90, or even $100. On forums and social threads, you can see this clearly, traders admitting they bought at higher and higher prices simply because everyone else was doing it. This creates a feedback loop where buying forces more buying, which pushes prices even higher. Institutions, meanwhile, are playing a completely different game. They use hedging strategies, derivatives, and volatility trades to profit whether silver goes up or down. Retail traders, however, often buy physically or through simple ETFs, and they typically make decisions driven by emotion. This imbalance can create dramatic swings, especially when institutional liquidity dries up or when retail inflows surge suddenly, causing mini short squeezes or liquidity gaps. So what does all of this mean for you? On one hand, the fundamentals supporting silver's rally are strong. Industrial demand is rising, the dollar is weakening, and monetary policy is turning more supportive for metals. On the other hand, a parabolic move like this always carries risk. Volatility can wipe out gains just as quickly as it creates them, and history shows that emotionally driven markets tend to overshoot before they correct. Investors who jump in blindly because of excitement or social pressure often get caught at the top. In conclusion, the dip to $62.70 and the explosive return to $70 shows us that silver is no longer trading on fundamentals alone. It's trading on emotion, hype, and momentum. This makes the market incredibly exciting but equally dangerous. If you're planning to enter, make sure your decision comes from research and strategy, not fear of missing out. Because right now, silver is moving fast, and emotional traders are moving even faster.